Troy Kearns, real estate investor, bringing it to you from my Las Vegas office. I'm back in Las Vegas from Kansas City, and I've got an exciting topic to talk to you about today where you can basically zero out your taxes. So let's get into it. So, what is a 1031 exchange? That's what we're going to be talking about today. And if you don't know what a 1031 exchange is, or if you're new to investing in real estate, I'm going to break down every single detail of what a 1031 exchange is. And you definitely need to be aware of 1031 exchanges if you want to zero out taxes when you're selling real estate. And another thing that you need to be aware of is that what's better for your health than anything is subscribing to the Troy Kearns channel, hitting the notification button, hitting the like button, and smashing it super hard. What is a 1031 exchange? Well, it's very, very simple. Basically, a 1031 exchange allows you to sell one property, take the capital gains, swap it with another property, roll those capital gains into that property, and defer them. How long are you deferring them? Forever. That's the goal. The only way you're not deferring them forever is if A, 1031 exchanges, Joe Biden nukes them.
President Biden's tax plan could be a triple threat to the real estate market and to investors.
Biden has released his tax plan targeting the real estate industry's 1031 exchanges.
President Biden announced part of his $1.9 trillion spending package includes eliminating a tax break for many real estate owners.
Or B, you don't do a 1031 when you go to sell that property that you just sold into the other 1031. Let's give you an example. You buy a house. I don't know where you're at. Maybe you're in Maine, maybe you're in Vermont, maybe you're in Las Vegas, or maybe you're in Kansas City, but you buy a house in one of those states for $100,000. It's a rental house. This has to be a rental house. This is for investment purposes only. You sit on that investment for 5 years, and all of a sudden, that's now worth $150,000. But you don't want to pay taxes on the $50,000 that you made. Let's say you took that $150,000 and then you bought another property for $200,000. You rolled the rest of the money into it. You're parlaying your money into another investment. As long as you're doing a 1031 exchange, you will never pay capital gains taxes on that property. One important factor to understand about 1031 exchanges, it can only be used for like-kind investment properties. What does that mean? It really means that it's got to be for investment purposes only. You can go from an apartment building to land, as long as it's for investment purposes. You can buy multiple properties. I'll give you an example. I bought 100 houses in 18 months in Kansas City. But the reason I was able to do that is I sold my houses in Vegas. I had like 16 of them, and all of them, I was able to buy 5 houses for 1. So my initial investment had grown so big that rather than selling it and taking the profit and putting it in my pocket, I went and picked 5 properties that I could 1031 exchange them into for no taxes. No taxes. The reason that people do 1031 exchanges is not only to avoid tax, but it's also to grow their investment portfolio. You see, when I have a $20,000 property that I bought in Las Vegas that's now worth $200,000 that's renting out for 7.25, that's a great return on a $20,000 property. But if it's a $200,000 property, that's not a good return. That's a very bad return. What do? You go and exchange that property for 5 in Kansas City that are gonna get you $725 times 5 versus times 1, right? That is the power of 1031 exchanging. Plus, if you want to take your money out, let me give you a little secret. That's what you call a refinance. Once you do the refinance, you pull the money out tax-free. There's no tax yet on refinances. So once I get all my loan done, I've got repair costs in it, then I can refi, pull my money out tax-free, then watch the property continue to grow, take that other money that I got tax-free, go buy more properties with that money. Pretty much, I can avoid capital gains as long as I'm paying attention to what I invest in when I'm using 1031 exchanges. Let's understand how the IRS defines what a 1031 exchange is. Under Section 1031 of the IRS tax code, like-kind exchanges are when you exchange one business investment property for another or others, but it must be solely held for investment purposes only. Can't be your primary. One interesting factoid that you might want to know is that this has been going on since 1921. The IRS adopted the 1031 tax code in 1921. Now that you understand what a 1031 exchange is, make sure you do one thing right now. You need to understand the rules of the 1031 exchange, because if you break these rules, you won't be able to use it. There are 3 primary rules that you have to follow when you do a 1031 exchange. So pay attention to these 3 rules. Number 1, the replacement property needs to be equal or greater in value than the property that you just sold. You gotta buy a property or properties that are equal or greater in value than the one you just sold. That's number 1. Number 2, your replacement property must be identified within 45 days. So you sell property A, property B, and C, if there's 2 of them, they all must be identified within 45 days or less. Number 3, last but not least, you must close on the property that you identified or the properties that you identified within 180 days of the property that you sold. Prior to doing a 1031 exchange, you were like, all right, what if I go and buy this property and I sell it for $150,000 and I buy something for $140,000. Well, guess what? You only pay tax on the $10,000 difference. So if you do a 1031 exchange, you still have to pay taxes on just the $10,000, but you don't screw up the whole 1031 exchange. Now, obviously I'm not an accountant, but that's what my accountant has told me. So check with your accountant, but just to hammer that point home, if the property was less in value, it would be taxed on the difference of the purchase price. You're not gonna lose the whole thing. And what I thought it was all or nothing when I originally got started, and it's not. We didn't place all of our money some of the times. We might have placed we sold something for $250,000, we might have placed $246,000. And maybe we're taxed on that $4,000, but not on the $246. Do you get it? You're taxed on the difference if you don't place it all. But if you place more, you're not taxed on anything. If you sold the property for $250,000, and then you bought a property for $260,000, you're not gonna worry about anything. All right, so what's the big takeaway from 1031 exchanges? If you're investing in real estate, you can pretty much guarantee, as long as 1031 exchanges are around, and as long as you're investing in real estate, you can kick the can down the road in terms of paying taxes. So get started investing in real estate, get started subscribing to our channel, get started hitting that like button, and we'll talk to you soon. Peace.